Tech giant's $400 billion AI bet. Returns on investment is the key issue. Extent of monetization will determine the future of many big companies. Author Ashok Neelakantan AS. New York. The world's most valuable technology companies are engaged in a spending spree unlike anything seen since the space race. Meta, Amazon, Alphabet and Microsoft intend to invest as much as $320 billion this year into artificial intelligence technologies, with Amazon offering the most ambitious spending initiative among the four, aiming to shell out over $100 billion. When the full, magnificent seven, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla, are included, these companies invest $400 billion a year into frontier technologies, namely AI and cloud infrastructure, with a combined value of $14 trillion representing 32% of the S&P 500. The scale is staggering. By 2024, cloud infrastructure capex hit $285 billion, and in 2025 alone, the top 11 cloud providers are forecasted to deploy a staggering $392 billion, more than the entire previous 2 years combined. Yet investors continue backing these bets despite mounting questions about returns. The gap between spending and revenue generation tells two distinctly different stories. Microsoft has emerged as the clearest winner in monetizing AI investments. Microsoft Azure cloud platform surpassed $75 billion for the fiscal year, up 34% from the prior year, with Microsoft's AI business surpassing an annual revenue run rate of $13 billion, up 175% year-over-year as of January 2025. The company's Azure and other cloud services revenue grew 33% year-over-year, with AI services contributing 16 percentage points to overall growth. Azure's 39% year-over-year growth in the fourth quarter of fiscal 2025 came in nearly 500 basis points above consensus, demonstrating genuine commercial traction beyond hype. OpenAI, the poster child for generative AI, presents a more complex picture. OpenAI has hit $10 billion in annual recurring revenue less than 3 years after launching ChatGPT, with revenue from consumer products, ChatGPT business products, and its API. The company's growth trajectory appears extraordinary. OpenAI projected significant revenue expansion, expecting to more than triple its total to $12.7 billion in 2025 from $3.7 billion in 2024. However, profitability remains elusive. According to a report published in The Information, OpenAI during the first half of 2025 collected $4.3 billion in revenue, while still posting a net loss of $13.5 billion during that 6-month period. More troubling for the monetization narrative, of ChatGPT's 800 million users, just 5% pay, with about 70% of OpenAI's recurring revenue coming from those paying for ChatGPT subscriptions. Meta Platforms shows mixed results. Meta is the only one where that eye-watering spending on AI appears to be paying off, with management saying AI has increased user engagement, time spent on Facebook and Instagram and conversion rates, with the price per ad growing 14% in the first quarter of 2025. The company reported that it now has 3.29 billion people using its apps, with AI-driven improvements translating directly to advertising revenue. Yet Meta stock fell sharply by 7 to 9% in after-hours trading following its third quarter 2025 earnings, with a significant decline largely due to a substantial one-time, non-cash tax charge of $15.9 billion and continued heavy AI investment raising questions about future margins. Amazon and Alphabet face similar scrutiny. Amazon's $25 billion in first-quarter capex made Meta's $17 billion look comparatively puny, with Amazon's AWS cloud division seeing revenue growth re-accelerate from the 12 to 15% range in 2023 to 17 to 19% over the past year. Alphabet delivered a blockbuster third-quarter 2025 earnings report, marking the first time the company's quarterly revenue surpassed $100 billion, a 16% year-over-year increase, with Google Cloud revenue growing 34%. Despite strong cloud growth, Alphabet and Amazon, despite their strong cloud businesses, have seen their stock performance lag the broader market in early 2025, as investors scrutinize the return on their substantial AI infrastructure investments. The AI arms race has produced tangible tools reshaping enterprise computing. Microsoft's integration strategy has yielded the most immediate commercial success. Nearly 520 million Office 365 subscriptions provide targets for Copilot, with more than 80% being commercial seats, while more than 230,000 organizations and 90% of the Fortune 500 have used Copilot Studio. OpenAI's product ecosystem extends beyond ChatGPT. The flagship offering is ChatGPT Plus for consumers at $20 per month, which has amassed roughly 15 million active subscribers as of mid-2025, making it the single largest revenue source, with ChatGPT Pro at $200 per month for power users with expanded usage limits. The company's API business provides the foundation for thousands of applications, though specific revenue breakdowns remain opaque. Meta has pursued an open-source strategy with its Llama models, not from altruism but strategic positioning. By making Llama freely available, Meta aims to commoditize the foundational model layer, preventing any rival from establishing dominant market position while strengthening its core advertising business through improved engagement. Google Cloud offers customers everything from computing time on a wide range of AI chips to access to a fully managed AI development platform called Vertex AI, with Google Cloud passing milestones of more than $10 billion in revenue and more than $1 billion in operating income in the second quarter.